cycles in the market. Before we begin, let's start with a simple definition of what a cycle is. A series of repeated occurrences with a starting point and an ending point. Without getting into the in-depth of each sequence of events, we'll rather focus on the distribution of the data for business cycles, using examples of standard deviations that measures the amount of variation of a set of values. In other terms, how much can the data deviate from the mean, the median line, during normal distributions. In the following context, we'll set the clock back to the 1900s. The 1900s, the beginning of a century where major development took place, transforming lives throughout history. It was a Sunday morning of late 2021, sometime during November, December of that year, where I woke up in the morning, prepared a cup of coffee while the family was still sleeping, and turned the TV on to Bloomberg News. It was here when for the first time I heard the name of Jeremy Grantham. He was speaking, giving his expectations or projections where the market will go, suggesting that this major bubble will wipe many investors from previous years with 3 standard deviations. It was this data set that caught my attention, where I've been studying since the distribution of data for normal distributions, also known as the bell curve, where you guys already know, I've been doing my homework, digging into the data, studying cycles. A basic form or an interpretation of a cycle is the sequence of events that has a starting point as well as an ending point. Throughout the length, we have the events occurring within the cycle. Therefore, this analysis for today will be a bit different from what we normally do. We'll be studying or reconstructing prior events that can take place on future price development, as we are within forensic analytics. Everyone, welcome aboard. This is Marvel 6. On another session of Forensic Analytics. Today, we're going to be looking at the data, major data from or since the 1900s. We're a century where the legends of the past, the titans of the past, also left us their homework, their work, their research to keep or continuing analyzing the price action within this fascinating field, which is trading. One of the basics interpretation of the data for the cycles will be, I need to illustrate the graphic for standard deviations, where I, as a harmonic pattern trader and also applying Fibonacci numbers, we can observe that the empirical rule, which is normally a metric where the data tends to distribute within a 60% or 68% normally for one standard deviation, 95% for 2 standard deviations, and 99.7% for 3+ standard deviation, where Jeremy Grantham is expecting the markets to go. Therefore, understanding these metrics, I apply Fibonacci numbers. The 68% could be within the golden pocket, the 0.618. The 95% can be within the deepest areas of retracement, for the 0.886, and also the 99% or the 100% move can be a retest of those lows, where the beginning of a cycle takes place until the end of a cycle. To put this into perspective, you guys already are familiar with the 1.13 we previously discussed. 1.13 is a Fibonacci number, a Fib extensions that normally, after major cycles, major reversal points occur, this is a key level where the market tends to find its bottom. We understand that there are many analysts making projections based on fundamental analysis, which is absolutely relevant as part of history, correct? Therefore, here we are on this event. I was going to release a video, but it's taking me way too long that I normally expect by editing a video. Therefore, I'm gonna try to explain this at least as part one for the major cycle. Okay? So now that you guys have a graphic or representation of the standard deviation for normal distribution, which is the graphic illustrated on the screen, now we're going to move into the same idea, the same empirical rule based on these three standard deviations, which I will leave this to the public for open interpretations. Therefore, you guys make your own judgment, okay? So let's begin. Once again, everyone, thank you for being here. Joseph, hello buddy. Nam as F, hello man. And Ben, thank you guys for being here, and everyone else who is behind the screen. To start with the cycle, we're going to move from the major one, the 1900s, the beginning of major cycles from June of 1900 all the way to October of 1903. This period compute a 3-year cycle, 1900 to 103. I wanted to go over each series of events for each cycle, but that is a very intense work. Therefore, I'm going to do this as practical as possible. What we can observe here is the beginning of the cycle to the end of the cycle. Applying the 0.886, this one can be a 3 standard deviation, applying Fibonacci numbers from the empirical rule. Once again, from these rules. You guys can observe the curve or the bell curve is where the data normally distributes to the 68%, the 95%, or the 99%. In order to be permissive, we're going to apply different levels of this empirical rule, applying Fibonacci numbers. The 100% can also deviate all the way to the 1.13, or can extend as an overspill of the data or the price action. Therefore, we already know and have in mind that if applying the same rule or similar rule by using Fibonacci numbers from the beginning of the cycle to the peak or the median line, this is something that we normally apply when it comes to trading. Fibonacci numbers for support and resistance levels. Here, you guys can observe that the 0.886 was the support level for the end of the cycle, for the 3-year cycle. Following after, the next one after, it started from 904, or we can compute from 903, to be more precise, to 907. The 907 panic, correct? In similar context, you guys can observe here that the 1.13, between the 100% and the 1.13, was within the support levels for the next bottom price action. The next one following here, I'm going to log my levels. It started from, again, each end of a cycle represent the beginning of a new one. Correct? From 1907 to 1914, pretty much the beginning of World War I. Early beginnings of World War I between 1915, and I believe the US joined in 1917 or so. So once again, I do not want to make anybody panic here, but if we go throughout history and study the major cycles, and if indeed we're about to head towards the 3 standard deviation, which is pretty much the 99%, or let's say the 100%, which is pretty much a retest of the prior lows, where the beginning of a cycle starts, that is normally where the end of a cycle also takes place before the new one begins. After the 7-year cycle, we then have another minor cycle, 3-year cycle. What I can observe here is that between the 3-year cycles and the 4-year cycles are between an average. Okay. However, each of these cycles are different from another, but there is a key level or a key metric, a key variable that I notice between each of these cycles, and I'm going to explain that at the end. Okay. Once again, standard deviations is a metric for normal distributions. However, normal distributions where the data tends to reverse, correct, at the beginning of the cycle, we normally have a symmetrical length from the median line and the length of the data from the left hand side towards the right hand side, where if we are indeed applying normal distributions for standard deviations, ideally the symmetry of the length from the left to the right should be equal or proportional. And this is where I notice something that I'm going to explain once again. From 1917, the US joined World War I. Here we have, from that period, 1917 to 1921, we have another recession with extreme deflation, where, I'm sorry, I did not go over the 1.13 here. Again, applying Fibonacci numbers from the lows, the beginning of the cycle, to the peak or the end of the cycle, the major cycle, we have the 1.13 within those parameters. Okay, so each one of these major levels are highlighted in green. Okay, so now since 1921, another end of a cycle, beginning of a cycle. The rapid recovery and full employment, right? Major upward move that took us pretty much all the way to 1929. That was another major cycle as well. 11-year cycle, 1921 to 1932. Okay, the major crash and the Great Depression. From 1932 all the way to 1942, pretty much another 10-year cycle, where the lows, pretty much here is where Garley came with this major pattern. I believe he talks from 1935, right here, the retest of those lows as a higher low, and the discovery of Carney comes here for the major M formation, based on the harmonic ratios, the 0.618 for the B point and the 0.706 for the PRC, only making here a highlight for the harmonic pattern within that 10-year cycle that took place from 1932 all the way to 1942, before World War II, 1945, correct? Since then, I only plotted here the major significant starting points and ending points based on standard deviations once again, okay? Applying the empirical rule with Fibonacci numbers. Since then, we have other minor cycles, the 2-year cycle, the 1-year cycle, that are also within a starting point from 1960s to the 1962. Another 2 sigma deviation with a 100% move, or pretty much a 3 sigma deviations will be these, the equal or the equivalent of that metric within the 100% or the 1.13. Now, moving back or fast forwarding from 1966 all the way to the 1970, a 4-year cycle, or 4-year cycle in 3 months to be precise. Here, you guys can observe for normal distributions, once again, the length of the skewness of the cycle should be ideally equal or proportional. But none of these are indeed equal. I notice that these are presented with a rise skewness. You guys can observe that the larger the length correspond to the left hand side of the major cycle. Okay? The next one, the following after, from 1970s all the way to the 1904 or 1974 for a 4-year cycle, similar characteristics. The left length from the medium line is larger than the right one, correct? Now, moving forward, you guys can do your homework and see each sequence of events, what took place within that period as part of history. I was going to do that, but again, it's an extensive work. But the main point here will be the timing, as many analysts are calling for a major correction, a major crash, the major bubble, which I agree, we have been indeed within a major cycle since 2009. So as we move forward, let's go back into another cycle here from 1900. The major cycles, once again, since 1900, the beginning of a new century. Here we have from 1980s to 1982, the 2-year cycle, another Gartley pattern, with potentially 2 standard deviations based on the metrics for Fibonacci numbers, or applying the empirical rule once again using Fibonacci retracement levels. In this segment of the move, we have only a minor cycle, 1 year. I'm not going to pay too much attention to those cycles because these are pretty much only temporary corrections within the major primary trend or upward move, but we're going to touch the points for the major cycles. From 1998, here's another major cycle, and also slightly similar. This will be pretty much the ideal scenario for 3 standard deviations that are symmetrical based on the cycles. Pretty much the length of the left-hand side of the cycle is equal or proportional to the right-hand side of the cycle, from the peak or the medium line to another 3 standard deviation. This is the only cycle that I found within the 4-year cycle from 1998 to 2002 that is pretty much symmetrical, okay, where the idea or the formula for 3 standard deviations applies. Again, if we use Fibonacci numbers from the lows to the highs, we have here another harmonic ratio, the 1 to 72, exceeding the 1.13, pretty much. Since then, if we move back forward, let's move into another major cycle, the 7-year cycle from 2002 to 2009, where prices correct or pretty much erase the entire move from 2002, went slightly lower and retest not only the 100%, but here's a very peculiar number. The 106 is also another number that comes to mind here, where I've been tracking and tracing this number that exceeds the 100% and goes to the 106. There are a few cycles I notice this number. Between the 100% and the 1.13 comes the 106 for the 7-year cycle. Now, since then, you guys already know, each end of a cycle represents the beginning of a new cycle. Since 2009, okay, we have these major cycles. And here's where I apply the sine wave to see where the prices are vibrating or resonating in, okay? And of course, many are assuming that we are already within the peak or the medium line that took place from 2021 as the axis of symmetry also for another parabolic curve or the inverse curve. And where can we go? As you guys remember, once again, if I go back into the standard deviation, the graph, if we apply the same, one key note to point out here is that the sine waves only represent the cycle lows and the cycle highs. It does not represent where the price action will go. However, once again, if we apply normal distribution with a standard deviation, where the data normally distributes after an accumulation or a markup period, then if Jeremy Grantham is correct, or based on his interpretation on statistics, we can then apply the same formula, assuming that the top is indeed in. But one of the key metrics I noticed is the skewness of the cycle, correct? In normal distributions, we understand that the length of the left-hand side of the cycle or the curve should be equal or proportional, once again, to the same length towards the right-hand side. Here, we are within the one or the monthly candle close, where we can observe that each bar represents 1 month, 154, the major cycle so far. We are indeed entering a major cycle. We haven't seen any distribution from this major point yet, but another key metric is to consider the skewness of the cycle, okay? The length, the right proportion between the medium line. But not all of the cycles were or are the same. They represent or they present a left hand side or a left skewness where the length of the move from the left hand side of the cycle is larger or major than the right hand side. But again, if we apply again the major cycles, and this is not a very spot of a new cycle from 2009, major crash from 2008, and since then we have this major pattern or this major upward move that we haven't the right hand side of the cycle yet, okay? However, there are other metrics, other variables that I apply by using the Gann box, the trend-based fib extensions, and if we're not indeed correcting, because we can indeed still vibrating or resonating between this major move for the sine waves, which is the lows from 2009, to the highs, we're still resonating or trading within this major cycle, let's say, where only if the major cycle low or the major cycle high is indeed at the top of 4800, we then indeed can compute and have a projection as to where the major low will be found within the market. That should be around the night or 2030, 2033, which can be another major cycle from the 1920, 29. Therefore, that can be another or can represent another major cycle, another 100-year period from 1929 all the way to 2029 based on cycles, major cycles, okay? But again, if we apply the same metric, the same data points from all the way to 1900, the major lows can indeed, or based on the empirical rule, we have the 0.618 as a key technical level that will be around between the 2000 or 2200 all the way to 200, or I'm sorry, all the way to the 0.886 as the deepest area of retracement around the 1200 period or range. And of course, the 100% will be pretty much wiping everyone out from the bubble, the major bubble of 2009, that can be indeed the 3 standard deviations. I believe that is my interpretation, where Jeremy Grantham is indeed maybe expecting based on this major cycle. Once again, I do not know that can be the case, because I do have other projections where, based on the skewness of the cycle, we notice that most of them represent the left hand side has the largest length of the move, where if we indeed continue to go high, and hypothetically speaking, only if we break the prior high, we then can potentially go to the fib extensions from the prior swing of the move, the peak to the lows, only if, okay, only if we're not breaking higher, then this can be a projected level. And that can take place all the way to 2026, applying the trend-based fib extension from the major low, 2009, all the way to the current highs as of now. Do we know this is the top? I do not know. If you guys know this is a major top, we can then, of course, make projections based on this. However, there are other metrics I presented yesterday a graph where I found very interesting the projected levels based on prior historical data where each time the Fed uh, discontinue the interest rate, we have the lag between 18 month to 24 month. Therefore, if we are continuing to see more interest rates until the end of the year, then we can project also or assume that that can be the case for the major top around 2025 or 2026. Where only since yesterday I found this article interesting because that aligns pretty much with the projected levels I do have for the S&P 500 is if we break the prior highs. You guys know that based on the monthly time frames, the variables are indeed being respected. We have higher highs or higher lows in the price action. This is probably the same idea we presented over and over. Lower lows in both oscillators, suggesting impending price action continuation towards the upside. That has been the case pretty much since the October lows. Now, the idea will be many analysts are expecting that we are not going to break the major high. We're going to retrace from here even. However, I've been calling or I've been projecting the 4,500 region since last year in October. During the stream, we presented the arguments for the variables for positive divergences that can indeed take us to higher levels, and has been the case at least so far. However, from here on, from 4,500, 4,600, if we go there, I'm going to be very cautious. Of course, I mentioned this before. It's also part of the stream. You guys can observe, go back and listen or revisit that stream from the prior stream on October 18th of 2022. I mentioned that let's not be too bearish here at the lows at 35, 36. Why? Because we have potentially the W formation. Though we're not achieving the 4,500 region, on futures we went to 44 and 98, I believe. Okay, in regular markets we achieve 44 and 60, so somewhere in that vicinity. But here is my concern. Since we're seeing all these major developments in history, right? We have World War I, World War II, now Ukraine, Russia. There's always some sort of catalyst that can take or can impact the market. And if that's the case, I do not want to believe that we are going to enter into a new war. But again, as history rhymes, we need to be prepared for anything, at least in the upcoming years. It does not look promising. Of course, I know many of the members call me bullish or bearish at times, but I like to trade accordingly. However, after doing this major study for the major cycles, we also know that during those events, major events, World War I, World War II were presented, and why not in the upcoming years, maybe World War III. I hope the best. I hope not we're going to go there. But if we go, yeah, we can potentially maybe go make a new all-time high to the 5,000 region. If we go, okay? I want to make this very clear. Only if we go there. And if so, doesn't matter really if we make a new all-time high in the markets and then we have a major depression, a major war, a major decline in the market. It's going to be, if that's the case, if history repeats, of course, from 1926 all the way to 1932 or 34, it's not going to be a period where we are going to have fun, right? You guys know nuclear wars are now in the cards, and we're seeing all these major developments taking place as part of history. And I do hope we are not going to go there. Once again, I do not want to make this a bear market case. But again, studying data, you guys can observe here all these sine waves. I try to define the major levels within the lows from 2021 to the lows of 2022. Was pretty much a year cycle where I was trying to analyze if we're indeed going to reverse from here. It should have been from here at the lows. You guys can observe we did not indeed. We, instead of creating a new low, we created a new bottom, let's say, at least so far, from 2021 or 2022, October last year. And we will see if this is the end of that period, or the beginning of the cycle low from October. And if we are going to just retrace from here and maintain another frequency here, you guys can observe here from the lows. I'm not sure if you guys can observe here on the stream or on the screen. From 2015, this is another beginning, pretty much from the sine waves to the highs. We can maybe be in that range or that frequency for the price action that can take place all the way to 2028, basically, if we are continuously trading or resonating between this cycle from 2015 to pretty much 2021, which is a 6-year cycle. We can maybe anchor the lows and make a 7-year cycle. That makes sense also. But again, this is a major cycle I'm tracking, slowly tracking, and even if we make a new all-time high, I hope for the best, once again, that we are not entering a major catalyst across the globe. Everyone, thank you for joining. This is Marvel 6, and I hope you guys have a nice day, and I'll see you guys on the next one. We're gonna keep trading, of course, regardless of the situation, right? But the major cycle seems to be not as promising, even though Jeremy Grantham, probably some of them are criticizing him by saying he was wrong. Another argument can also be that he was early, like he already was before. But this one was a pending lesson, in my opinion, as a trader, from the 3 standard deviation, which is basically another interpretation of statistical analysis. In this case, what I do is apply Fibonacci numbers, replacing the empirical rule, the 68%, the 98%, and 99%. We can, of course, apply different interpretation and trade accordingly. Everyone, I'm still going to try to release a major cycle, but to have a better idea, because I've been postponing since pretty much April. I was trying to make the editing of the video, but it's taking me very long. So the main idea is this cycle, the major cycles from the 1900s. And that can also be, as I already said, another cycle, another century from 1929 to 2029, where the timing remains as the X factor. Everyone, thank you for joining, and I'll see you guys on the next one. And remember to live a life with an attitude of gratitude. Cheers.